Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And tonight on the show, we're talking about apartments and capital growth. And this is a really interesting one that has come from a listener of the show, Preston, who said, I wonder if you could get us some data about apartments, specifically comparing apartments in a central city like Auckland compared to an apartment in Auckland that's maybe a little bit further out. The thinking being that, you know, an apartment right in the middle of the city would have more competition because there's lots of apartments there. So perhaps those ones might get less capital growth than somewhere or an apartment further out of the city because there's, you know, few apartments out there. So could you check this out for us? So absolutely, Preston, we can. And in order to do this, I thought, let's do this Mythbuster episode properly. Let's form some hypotheses as if we're doing our PhD on apartments and capital growth and that we can then answer it. Now, just to be clear to anybody who's actually got a PhD and is obviously very clever out there, we're obviously making a joke because neither of us are that clever to make it all the way through university to get to the end of it.
I didn't even start.
So what are our hypotheses, Andrew?
Well, firstly, see, not smart enough to even get my sentence out.
I actually do have degrees, though, people, just so if anybody knows. If anybody's like, did anyone
so does my
no, I
oven. Shut the hell up. Jumped up little yeah.
Just bleep those out. It's actually quite funny, David. Get back to the property data, Andrew.
Oh, sorry about that. Well, the apartments in central city Auckland get less capital growth than somewhere else in Auckland, potentially due to the increased competition in central city Auckland, because obviously there's far more apartments there than there are in the likes of Ellerslie, which we've spoken about recently. And that apartments in a premium area such as like Mount Maunganui get more capital growth because than less premium areas.
Okay, so we've got our hypotheses here. Now we've got to figure out our method to solve these, see whether these are true or not. Now, what we've looked at is we've used, as we like to do, the house price index, the Ryan's house price index, and specifically compared apartments versus dwellings. Now, if anybody hasn't heard my rants about the house price index, just want to explain it. So there are really two methods that people use here in New Zealand in order to calculate capital growth. The first is you can look at the change in median house prices within a suburb. The good thing about that is you're able to get a really tight geographic area. So I can look at, what was the average price of a property or a mean price of a property in central Auckland in January 2000. Well, what was it last month? What's the difference? Now, what's the issue with that? Well, the stock of properties changes over time. And what I mean by that is different properties sell at different times. You've got new builds or new stock being introduced, new properties built over time. And so that will change that average. And that's why you'd use a house price index, which is a much better way of looking at capital growth. The issue with the house price index, though, which is what we get into, and I'll talk about a little bit more, is that it's less targeted. I can't look at the price of apartments or the change in value of apartments over time in central Auckland only, but I can look at the old Auckland City Council geographic boundary and look at properties within there. So that's the data set we're using. And what we're specifically going to compare as well is what we call the capital growth discount. So we know that apartments get less capital growth over time than other types of dwellings. We've seen that time and time again on the show. But what I really want to know is not whether Auckland City got 4% capital growth for an apartment and Wellington got 5%. That doesn't mean as much to me as, well, what was the difference for each of those compared to what other properties within that city actually got? So that's what I call the capital growth discount. So how much less capital growth did an apartment get relative to other dwellings or other properties within that specific area? So we're going to be specifically looking at that. And look, we've run into some issues when you use this method that I just want to point out. The first is, look, New Zealand's quite a young country, and because of that, we don't have a lot of apartments in general. So while I can download capital growth data for apartments for all 73 different council areas that we've got in New Zealand, only 13 actually had any data. Now, the reason for that is that places like Carterton District have no apartments, or very, very few apartments, and so there's no data about the value of those apartments. So what we've had to do is we've had to narrow down, look at the 13 areas of New Zealand that actually do have some data. We had to match it up because there were some issues where 1 month it might be blank, another it might have a value. So we've matched it all up, and we've tried to find out a good answer to the hypothesis. So we've had to do a bit of jerry-rigging, we've had to do a bit of number crunching, but we're pretty happy with saying, look, let's answer these hypotheses. So Andrew, take it away. Do Central Auckland apartments actually get less capital growth than apartments elsewhere in Auckland?
So there are 5 territorial authorities for Auckland that we've got data for, and Auckland falls right smack bang in the middle of the 5, which is really interesting, and their growth was 5.5%. Manukau was at the top, 5.79, and North Shore at the bottom at 4.62. So not a huge amount of spread between the bottom and the top. So it's probably not really supporting our hypothesis so far. And yes, we could dig further into the detail and go into the median sales prices for the suburbs, but we're not as confident in the results of that.
And I suppose what we would have expected to see if, Auckland City apartments really had the worst capital growth compared to everywhere else in Auckland, we would have expected to see Auckland City right at the bottom. Now, I think what's important to note as well is that while Auckland City, for instance, I believe it had capital growth for all dwellings was 8.16% per year. Apartments had that 5.5%. Now, I realise that that's significantly lower, but do you know what? 5.5% for an apartment is actually not terrible over the long term when we're talking about annual capital growth, because you probably had a relatively okay yield over that time.
And if you think about Christchurch as a whole, that's probably historically been about that 5% mark, or maybe 5.5% over a long term. So it's not drastically different from a house in Christchurch when you put it that way.
So what I want to do now is transition over and talk about that capital growth discount. And let me just give you an example of what I mean by this so that we're fully across it. So North Shore City. So we just said there, apartments in North Shore, 4.6% per year over that long term. That's what apartments grow in value at. If we look at dwellings, they had about 8%, just over 8% capital growth per year. So that's your standalone houses, that's your townhouses, that's your units, anything that's not an apartment. So what we call that is we say the capital growth discount was 43% over that time, because per year, and of course that does compound, but per year apartments got 43% less capital growth compared to other types of dwellings. Now, the hypothesis we're trying to say is, well, do apartments in premium areas like a Mount Maunganui, do they get more capital growth for their apartments compared to perhaps some less premium areas? Now, what I've done is I have ranked the various areas that we've got data for by that capital growth discount. So in which areas did apartments get almost as much capital growth as other areas? And what we've actually found, it's quite fascinating, Andrew, when I've ranked them, the trend that I tend to see is that the areas that have the smallest capital growth discount between apartments and other types of dwellings tend to be areas that don't have a lot of apartments, because they're more, I don't want to call them fringe cities, but I want to say they're the smaller cities. So, for instance, in Christchurch City, I'm not sure whether I really believe the data that's come out of here, but according to Christchurch City, apartments actually got more capital growth. It's one of only 2 cities where this actually happened out of the 13. Apartments had more capital growth than other types of dwellings. Now, look, that could be for a number of reasons. If apartments were particularly undervalued or were particularly cheap at the time that this index started or from we're measuring from, there could be a number of reasons.
Yeah, I'd say actually probably, depending on when this is probably about more apartments being built by the likes of, say, Williams Corporation have made them a lot more normal in Christchurch than previously. Previously, when we talk about apartments, we're probably talking about a very select number of apartments that are around.
And then similarly, a place like New Plymouth had only a 15% difference per year compared to apartments versus dwellings. Hamilton, Taupo, Queenstown, Nelson, Dunedin, all of our smaller cities that kind of have under 150,000, under 250,000 people living there. The areas that had the biggest discounts between apartments and dwellings, those were places like Wellington, Rodney District, Auckland City, Manukau, actually all different parts of Auckland, but mainly Auckland and Wellington in there, which was quite interesting. It made me think, well, maybe it's because you've got significantly more apartments in those cities, and therefore you've got more competition between apartment buildings if you've just got a higher stock of those. Whereas if you think about, good old New Plymouth and my home region of Taranaki, you've probably only got 100, 200 apartments there, so there's not a lot of competition between them. In fact, I'd say there's probably less than 100 apartments in New Plymouth, whereas you've got a whole heap of houses there. So perhaps that's one of the reasons why you don't see that sort of capital growth discount. So I think in both cases, our hypotheses ended up being kind of incorrect, if I can say that, Andrew. Did Auckland City or Central Auckland get less capital growth than other parts of Auckland? Well, we haven't seen that. Though bear in mind that, of course, Auckland City includes places like Aoraki and Mission Bay, areas that have their premium apartments. And similarly, did we see more premium areas getting a smaller capital growth discount compared to other types of dwellings? No, we didn't necessarily see that. We saw a different type of trend, actually, where the smaller cities tended to have pretty healthy apartment capital growth. So I suppose that's kind of interesting. Anything you're picking out from this, Andrew?
Well, no, I just was kind of thinking, making that jump, and I've done this before myself, made the assumption that because there's more of something, there won't be the same sort of growth. But actually, that's probably not why there's lots of options there. It's because the demand supports the need for something. If you're buying an apartment in Auckland, you probably want something in the CBD so you can walk to everything, because you might not have a car park and you don't have a lot of space for storage. So you just want to be able to walk to the viaduct and stumble your way home after a few drinks. So, I mean, that's probably why you see more of those things there. And that probably doesn't mean that, you're going to be flooded. It just means that that's where people naturally want to be.
And I mean, you'll enjoy it once you move into your Henderson apartment, being able to stumble home from the viaduct back to Ken as well. Hey, look, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. It really does help us get the message out to more people. And hey, if you want to learn more about property with Andrew and I, come along to our next webinar. It's happening this Tuesday, 16th November at 7 p.m. And we're going to be talking about the debt to income ratios and the tougher servicing requirements that a lot of the banks are introducing. So how do you continue to build an investment property portfolio when it's harder to get money out of the banks? So if you want to come along to that, tap or swipe over the cover. I'll drop a link into the show notes, or just go to openspartners.co.nz. You'll be able to sign up there.
You need to leave the jokes to me.
That's not funny. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.